Hello everyone, I'm Matt Sauer with Different Mortgage. Welcome back to our channel where we try to make understanding mortgage rates and economic principles easy to understand. Today we're diving into a topic which is hot right now, and I'm sure anyone looking into buying a home or has a home is always interested in what are mortgage rates doing and what does exactly affect them. So today we want to look at the broad stroke economic things that affect them, but then also the localized things you as an individual can do to affect your interest rates as well. So let's dive into those. First thing we're gonna look at is the market conditions. One of the big ones, inflation. I think everybody has been familiar with this. Anytime you go to the grocery store, you go out to dinner, you're just like, wow, things do not seem as cheap as they used to. That is inflation when the cost of goods rise. So therefore, lenders want to get a higher return on their money to keep up with inflation, and then one of the ways that the Fed, which we'll touch on, tries to curb inflation is raising interest rates. So that's number one. Number two is economic growth. Typically, when the economy is doing well, it's growing, it's kind of booming. In that growth space, things tend to inflation tends to go up, and then therefore rates tend to be a little bit higher as well. When we hit into economic turbulence, such as a recession, that's typically when we see an effort by the Fed to try to stimulate the economy, and then in that they lower interest rates to try to get more activity going. And then number three is, we talked about previously, is the Federal Reserve. Now the Federal Reserve, they are trying to curb inflation with raising rates. So when they see that the inflation has come down at a sustainable level, their target's like 2%. I don't know how realistic that is, but even 3% consistently, or we hit economic turbulence, that's when they start to cut their rates. Now interest rates, mortgage rates specifically, are tied to what the Fed does, but they're also tied to what is called mortgage-backed securities. And that's where people are buying and selling mortgage-backed securities in a secondary market, and they want a certain yield. When everyone's buying, the yield comes down, rates come down. When they're not buying, the yield goes up. So a big part of that is the Fed actually has a certain amount of mortgage-backed securities they buy. So when they buy large portions of that, it brings the rate down. But when that's quantitative easing. When they're quantitative tightening, they're selling those off, which is kind of what's going on now. They go up. So the Fed has tools beyond just what you see. Hey, they raise rates, they lower rates. That has some effect on what the long-term interest rates do, but it's not always a one-for-one. It's also what is going on with quantitative easing or tightening, if you ever heard of that. So again, those are things we want to watch on a big, broad economic stroke that are going to drive things. Pretty much every week there's a new report out, whether it's the core inflation report, the jobs report, all kinds of reports every week that the Fed is watching, and that drives their policies. So we're always interested to see what they do in their meetings and what the economy's doing, and that's going to help kind of guide where rates go. Right now we're in a high rate market. I would say until the Fed starts seeing those inflation numbers come down, or the economy cooling down, they're probably going to keep them higher longer than we thought. And then if we hit a bump, they'll start bringing those down on their side. So those are the broad economic ones. Now let's look at ones individual that are more personal for you. So now on a personal level, I'm sure a lot of you guys will be familiar with a lot of these, but there's things you can do that affect your interest rate on a micro level. Number one, credit score. Guidelines have changed. The pricing models have changed just this last year with Fannie Mae and Freddie Mac, where the higher your credit score can have a bigger difference in what kind of rate you get. So there's typically costs associated with different credit scores, and usually most people don't want to pay those. So how do we get around that? Interest rate goes up, and the bank will give you the lower cost with that higher interest rate. So your credit score is a big factor on that. So if you're working on it, try to keep working on getting your credit score higher, because it can make a big difference. Number two could be the location of where you live. Higher cost areas, higher loan amounts typically have higher rates. Lower costs, sometimes you can stay in that conforming limit and keep the rate down. Getting into if you can qualify for VA or FHA or even a rural property, that can affect them as well. So home location, as well as looking at the next one, which goes into that, is the down payment. So the bigger the down payment you have, the more equity you have, that with your credit score is going to dictate the pricing that you get. So And we're probably talking about a 1/4% difference in rate, potentially even, drastic difference, maybe even 0.5%. So it can have a big factor. We already talked about home price and loan amount. Again, the higher the price, the higher loan amount, and the lower the amount down, it's going to affect with a higher rate too. And if you ever need to look into all those details, love to help you with that. I always do the back of the napkin stuff to look at, hey, what is your credit score? How much you're looking to put down? What would that pricing be today? And then here's some ideas of maybe what you could do if you're not looking to buy like immediately, to try to get that into a better situation. We could play with like, hey, what if we affected the credit score a little bit? What if we got the down payment down a little bit? What if we tried this different program? And that's where you really need someone that can analyze all that and help you make a good decision. Instead of just calling someone and they just quote your rate based on where you're at. You want to think forward looking, and that's where, what I try to do personally as a mortgage broker and an investor, strategist. So that's a little bit, more about what I can do for you.